Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about VERISIGN Inc. Annual Report. VERISIGN Inc. offers a range of internet infrastructure services that facilitate navigation and commerce on the web. At its core, the company provides domain name registry services, which enable users to access various recognized domain names worldwide. This includes operating 2 of 13 internet root servers, ensuring global e-commerce is supported. In addition to these core services, VERISIGN operates directories for specific domains such as name and CC, providing authoritative resolution for com and net domains. The company also offers back-end systems for edu domain names, further expanding its reach in the online world. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what may cause a stock price to remain stagnant. The stability of VERISIGN Inc. CA stock price over the past year is likely due to a combination of factors. One possible reason is that the company's financial performance has been consistent and predictable, with no major surprises or disruptions in its revenue growth or profitability. This consistency can lead to a lack of volatility in the stock price as investors become accustomed to the company's steady performance. Another factor contributing to the stability of VERISIGN Inc.'s stock price may be the company's dominant position in the domain name registration and internet infrastructure market. As a leading provider of these services, VERISIGN Inc. has a significant moat that protects its market share and revenue streams. This dominance can lead to a stable stock price as investors are less concerned about the company's ability to maintain its market position. Additionally, the overall market conditions may also be contributing to the stability of VERISIGN Inc.'s stock price. If the broader market is experiencing low volatility or a period of consolidation, it can have a stabilizing effect on individual stocks like VERISIGN Inc. This means that even if there are some underlying issues with the company's performance or industry trends, the overall market conditions may be masking these concerns and contributing to the stability of the stock price. In summary, the combination of consistent financial performance, dominant market position, and stable market conditions may all be contributing factors to the lack of significant changes in VERISIGN Inc.'s CA stock price over the past year. VERISIGN Inc. market capitalization of $21 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that VERISIGN Inc. holds a significant advantage in their industry. VERISIGN Inc. trades at a higher price-to-earnings ratio of 25 times and a lower price-to-book ratio of -9.56 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 262% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the domain name registration industry are multifaceted. On the growth side, several factors contribute to increased revenue. One key driver is the increase in maximum price for com domain name registrations, which can lead to a significant boost in revenue. The expansion of existing technologies, such as artificial intelligence, AI, also drives demand for domain names, while the successful acquisition and operation of new GTLDs further expands the market. The adoption of new technologies that increase demand for domain names is another crucial factor. Effective marketing efforts by registrars and resellers have also led to an increase in demand and renewal rates for com and net domain names, particularly in developing and emerging economies. Furthermore, a significant increase in new domain name registrations and renewal rates has been observed. On the other hand, several factors contribute to revenue decline. Competition from online identity services is a major concern, as it erodes the traditional market share of domain name registrars. Failure to adapt to changing cybersecurity threats and regulations also poses a risk to revenue growth. The emergence of new technologies such as AI and blockchain further disrupts the industry, leading to decreased demand for traditional domain names. Consolidation and ownership changes in the industry can also lead to revenue decline, as well as changes in registrant motivations and a shift away from traditional domain names. Overall, the domain name registration industry is subject to various drivers of growth and decline, requiring careful management and adaptation to stay competitive. The net income of the company underwent a fluctuating trend between 2023 and 2025. Initially, it decreased by $31.9 million from 2023 to 2024 due to an increase in selling, general and administrative expenses, and interest expense. However, this decline was followed by a significant increase of $40 million from 2024 to 2025, although the exact reason for this surge is not specified. The profit margins also experienced changes during this period. The operating income margin decreased slightly from 67.2% in 2023 to 68% in 2024, before increasing to 67.9% in 2025. Meanwhile, the net income margin saw a decline from 54.7% in 2023 to 50.4% in 2024, and then increased to 49.9% in 2025. The decrease in profit margins from 2023 to 2024 was attributed to an increase in income tax expense due to state income taxes and U.S. taxes on foreign earnings, net of foreign tax credits. Overall, the fluctuations in net income and profit margins can be attributed to various factors such as changes in expenses, tax rates, and other economic conditions. The company's financial performance indicates a steady increase in operating cash flow over the past 3 years. In 2025, the company generated an impressive $1,091.1 million in operating cash flow, marking a significant improvement from the previous year. This upward trend is also evident when comparing the data from 2024 and 2023, where the company's operating cash flow increased by nearly $59 million. The substantial growth in operating cash flow suggests that the company is effectively managing its operations and generating sufficient revenue to cover its expenses. This positive development is a testament to the company's financial health and stability, providing a solid foundation for future growth and success. The company's debt level has undergone significant changes over the past year. According to the extracted summaries, total debt increased to $2.75 billion in 2025 compared to an unspecified amount in 2024. Long-term senior notes also saw a notable increase from $1.492 $5 million in 2024 to $1.788 $2 million in 2025. However, senior notes decreased slightly from $1.69 billion in 2024 to $1.75 billion in 2025. In terms of interest expenses, the company has experienced mixed results. While some pages indicate a decrease in interest expense, such as a -4.6% drop in 2025 and a -4.8% drop in 2024, others suggest an increase or no change at all. The payment of interest on the 2032 notes in June 2025 contributed to an increase in interest expenses. However, cash paid for interest decreased from $72.8 million in both 2023 and 2024 to $78.7 million in 2025. Overall, the company's debt level has increased significantly, but its interest expenses have been inconsistent across different pages of the report. The global market has shown mixed results across various regions and segments. On one hand, some areas have experienced a decline in performance. In China, regulatory mandates led to a decrease in demand for services in both 2023 and 2024. This trend is also reflected in the APAC region, where revenue decreased by 0.6% compared to 2023. On the other hand, certain regions have shown significant growth. The EMEA region has seen an impressive increase of plus 12.1% in revenue from 2024 to 2025, and a substantial rise of plus 22.1% from 2023 to 2025. Similarly, the U.S. market has experienced steady growth, with a revenue of $1,093.1 million in 2025, representing an increase of plus 6.2% compared to 2024. These contrasting trends highlight the need for businesses to adapt and focus on regions that are performing well, while also addressing the challenges faced by areas experiencing decline. Management's outlook for the company is one of growth and innovation. They plan to expand their business through targeted marketing campaigns, which will help them reach new customers and increase revenue. To protect against cyber threats, they aim to develop new capabilities for DNS registration and resolution infrastructure. In addition to expanding their business, management also wants to invest in research and development (R&D) that benefits the DNS and Internet community. This will not only enhance their current technologies and services, but also lead to the development of new ones. They recognize the importance of talent development and acquisition, which is essential for meeting business needs and driving growth. The company's strategy also emphasizes the protection of intellectual property through patents, trademarks, and confidentiality agreements. Management believes that the strength of the VERISIGN brand will continue to differentiate their products and services in the market. Furthermore, they are committed to adapting to ICANN's consensus policies, technical standards, and other processes. To stay ahead of the curve, management plans to manage AI use through a corporate AI policy by a cross-functional AI steering committee. They also expect future enhancements to existing services and new services from internal development efforts and collaboration with suppliers, vendors, customers, and the technology community. Overall, management's strategy is focused on growth, innovation, and protection of intellectual property, which will help the company remain competitive in the market. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. As per the extracted summaries, the company has paid dividends on multiple occasions, with specific details available on pages 17, 22, 25, 30, 39, and 62. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. The summaries indicate that the company has bought back shares on several instances, with further information available on pages 30, 39, and 60. This demonstrates a commitment to maximizing shareholder value and providing returns on investment. That concludes the financial summary for VERISIGN Inc. Feel free to comment below, and I will be happy to answer them when possible.